Hi, this is James Shug with Westpac London's end of day report for Thursday, October the 27th. Well, as Kath would say, I've got one word to say to you, and that's European Debt Leaders Summit. And certainly markets have reacted very positively to the early hours announcements from Brussels. Of course, this happened in Asian trading time, so I'm probably not telling you anything you don't know. And even though there's, from an analytical economist perspective, there's a lot not right with what's been agreed. It really doesn't go far enough. Certainly markets were impressed that relative to very low expectations in the lead up to the meeting, we at least got two of the three things that we'd been expecting, and on the third, the expansion of the EFSF. It's going to happen. We've got an idea. It's going to be expanded to about €1 trillion. We just don't know the detail of how that's going to happen. That's going to be decided in the next month or so at a European Finance Ministers Summit sometime in November. But the 50% haircut that was agreed between the banks and EU leaders by Sarkozy and Merkel, basically saying you get either that, lose 50% of your investments in Greece, or we declare Greece insolvent. With a pistol to their head, they agreed to that. And on the bank recapitalisation plan, that looks like being sufficient, at least for the banks that have got problems related to their exposures to Greece. Although when you add in the private sector and when you add in concerns that we've still got about other parts of Europe, it may yet prove to not be enough. In fact, a couple of issues I suppose I would raise. We're gradually getting more and more compelling evidence that Europe's slipping into recession. That's going to make it harder to cut budget deficits. That's going to mean that at some point down the track, this plan probably won't be sufficient to fully meet the concerns of investors in sovereign markets in Europe. The miss in terms of budget deficits related to targets, the more likely it is that we see another bout of market volatility and yields pushing sharply higher. So, and certainly the data today on Europe wasn't particularly good. We saw a range of business surveys for October, all of them again pretty much where they were either in the first or second quarter of the recession in 2008. In other words, they've been falling this year. They've already fallen to the levels that they were at last in 2008 when the recession had already started. So more signals that Europe's either on the edge of or already in recession. That's certainly not an official view from anyone in authority in Europe, but certainly we're saying it, and interestingly, as I said yesterday, the Bank of Canada's saying it as well. Other issues about Europe. Will Portugal and Ireland want a Greek-style haircut in terms of their debt obligations? And will the European Central Bank cut interest rates next week? I mean, that's certainly a vital part of any solution to the crisis from here on, given that Europe is probably in recession at the moment. In terms of other developments today, we had economic growth numbers for the US, a 2.5% annualised growth rate there. That's the strongest since the end of last year. What it basically showed was that spending on services and durables like autos by households, spending by businesses and plant and equipment was accelerating. Housing was negligible again. Net exports made a small contribution. Government spending was flat. And actually inventories shaved quite a chunk off the number. It would have been 1.1% stronger if that extra demand had actually been met from extra production. But actually in actual fact, a lot of it was met from previous inventory build-up. So a headline in line of expectations, but the detail was actually pretty positive. We did, however, have a 4.5% fall in sales of existing homes. This is not contracts, but conclusions, but pending sales of existing homes. In fact, they're down 3 months in a row now. So the housing sector, on a range of indicators today, still looking pretty soft. They're probably the main bits of news. Oh yes, we had German inflation figures, just a very slight deceleration in October from 2.6 to 2.5% annual, which means that the European inflation might soften a little bit in figures coming up in the next day or two, which might make it marginally a little bit easier for the European Central Bank to cut interest rates next week. We'll have to wait and see on that one. Okay, so given all that, look, really it was all about Europe. At the close, we had the London market up 2.9%, the French market up 6.3%, the German market up 5.4%. And as I'm speaking, we've got the Dow in the US up 2.6%, It's at 12,180, and the broader S&P measure, sorry, the Dow's up 2.6, the broader S&P measure up 2.9%. So we've still got another 3 hours or so of trading to go though in the US. So very positive day today. No big earnings reports to mention of note. On the commodity front, pretty positive there. We've got 5.7% rise in copper prices, a 3.6% rise at the moment in oil prices, $93.44 a barrel, and gold's up 1 1/3% at $1,746 an ounce. I watch the Aussie at the moment. 1.071 for the Aussie against the US. So that's just 3 cents off its recent high. So what's that, up a couple of cents today. Equity market stronger, commodities stronger, the Aussie dollar's rising sharply as well. And notwithstanding the fact that we still think there'll be a cut from the Reserve Bank in Australia next week. All right, that's it from me. Back tomorrow. Bye-bye.